Hello, my name is Sergio Estavio. Just thought I'd do a presentation concerning income-based repayment as well as pay-as-you-earn to do a comparison between the two income-driven repayment programs. If you have questions or concerns during the course of this presentation or after this presentation, feel free to drop me an email at that email address at the bottom or give me a call. So let's go ahead and get started. So pay-as-you-earn was introduced in December of 2012. So it's a little over a year old and became available at that time. Income-based repayment was introduced in 2009, so that program has been available for about 3 years now. Pay-as-you-earn is a more beneficial program as compared to IBR, but pay-as-you-earn does have limitations as to who qualifies. So those individuals who qualify have to meet 3 of the 4 bullet items. So the first bullet item is that you cannot have an outstanding balance on a direct or FFELP loan. FFELP stands for Federal Family Education Loan Program as of October 1st, 2007. So again, you cannot have an outstanding balance on a direct or FFELP loan as of October 1st of 2007. Or if you did have a loan that was issued on or before October 1st of 2007, you would have had to have paid that off before receiving a new direct or FFELP loan on or after October 1st of 2007. If you meet that condition, then you also have to have received a direct loan disbursement on or after October 1st of 2011. And finally, your payments under pay-as-you-earn must be lower than the 10-year standard monthly payment amount, otherwise defined as having a partial financial hardship. In most cases, I would imagine for dentists who are borrowing significant amounts, your pay-as-you-earn payment, if you qualify, will be less than your 10-year standard payment amount. So that shouldn't be a concern. It's really whether or not you have, if you took out any loans prior to October 1st of 2007 and you had a disbursement issued on or after October 1st of 2011. And the only loans that are eligible for pay-as-you-earn are direct loans. So if you have a combination of FFELP loans and direct loans and possibly, say, the Health Professional Student Loan Program, it is advisable that you consolidate all your loans and you convert them into direct consolidation loans. As a result, you would then qualify for pay-as-you-earn if you meet those other criteria, such as not having an outstanding balance on federal loans on or before October 1st of 2007. In order to consolidate, you can visit this site to consider consolidation. So it is mentioned here in this disclaimer, if you're interested in repaying your direct loans under pay-as-you-earn, you can visit this site to get some more information. Then once you read that disclosure information, go ahead and go to Borrower Services to consider completing a direct consolidation application. So if you have questions about that, about completing a direct loan consolidation or the repayment options available under direct loan consolidation, you're welcome to give me a call concerning those items as well. Now, with respect to income-based repayment, really there's only one qualification criteria that you need to meet, and that is that you have to demonstrate a partial financial hardship, meaning that your payments under IBR must be less than the 10-year standard monthly payment amount. So most students would qualify based on that criteria, again assuming that you're a medical student or a dental student who has a significant amount of debt, and as a result your 10-year standard monthly payment amount is considerable. The loans that are eligible for IBR are both FFELP as well as direct loans. HPSL is not eligible for IBR or pay-as-you-earn. So one consideration would be to consolidate those loans under the direct loan consolidation program, making them eligible for IBR or pay-as-you-earn consideration. Of the two programs, pay-as-you-earn is much more beneficial than IBR, but there are conditions as to who qualifies. So you first need to identify whether or not you qualify. And the reason it's more beneficial is based on these bullet points. So for pay-as-you-earn, the monthly amount or the annual amount is based on 10% of your adjusted gross income less a minimal living allowance. So the effective rate is approximately 9% of AGI. Just a quick example. So assuming that you have an adjusted gross income of $100,000, under pay-as-you-earn, your annual payments would be about $9,000. Divide that by 12 to get a monthly amount, then you're looking at approximately $750 per month on a payment under pay-as-you-earn. As compared to IBR, they look at 15% of your adjusted gross income less a minimal living allowance. Again, the effective rate here is about 13% of AGI. So on $100,000 on an annual basis, you're looking at about $13,000. Or on a monthly basis, you're looking at a little over $1,000 per month. So that's one of the reasons why you want, if you are eligible for pay-as-you-earn, maybe you're currently in IBR, you want to consider migrating to pay-as-you-earn, because it does drop the monthly payment amounts by about a third. Secondly, your repayment period under pay-as-you-earn is 20 years as opposed to 25 years with IBR. Another item to consider is that under pay-as-you-earn, if you no longer qualify, and I'll get into reasons why you don't qualify in a bit, any interest that is capitalized is limited to 10% of the outstanding principal balance, that principal balance being the amount when you entered repayment, and that could be a significant benefit to you. So let's assume that you entered repayment at a principal balance of $500,000. Under this criteria or condition, with pay-as-you-earn, they limit the interest capitalization to no more than 10%, or $50,000 in this example, of the original principal balance. And again, this could be significant savings to you. Under income-based repayment, if you leave IBR or no longer qualified, all the unpaid interest, otherwise known as negative amortization, will be capitalized to the principal at the point that you no longer qualify. And the negative amortization can be significant. So, if you're able to qualify for pay-as-you-earn, I would certainly give it serious consideration, particularly if you're in income-based repayment right now. You would want to migrate from IBR to pay-as-you-earn. So some of the benefits in choosing either of these income-driven repayment options, pay-as-you-earn or IBR, are listed there. Compared to a more traditional repayment schedule, say a 10-year repayment schedule, your debt-to-income ratio under IBR or pay-as-you-earn will probably become much more competitive. A lender will look at your debt-to-income ratio for the purposes of, a mortgage a practice loan indirectly, to see if you're able to service your debt in a manageable fashion. For example, a mortgage lender may not like to see more than 40% of your gross income being consumed by debt obligations. And debt obligations will include, car payment, credit card payments, your student loan payments, plus the other type of debt you're trying to secure, so your mortgage loan amount. And a lender doesn't like to see more than 40% of your income being consumed by that debt obligation. So if you're in a standard 10-year repayment schedule, and you have $500,000 outstanding in student loans, your payments under that repayment schedule will be approaching $6,000 per month. So you may not qualify for a mortgage as a result of that significant student loan monthly payment based on a 10-year repayment schedule. So under pay-as-you-earn as well as IBR, you're going to probably drop your debt-to-income ratio significantly, opening up other financial opportunities such as a mortgage as well as potentially a practice loan. Second bullet point, your cash flow may improve significantly as a result of moving from more traditional repayment schedules such as pay-as-you-earn as well as IBR, so that your monthly payments under these repayment schedules are significantly less. It just improves your cash flow, something that a practice lender might like to see, so that you have more funds available to meet your obligations with respect to a practice loan. Third bullet point kind of captures those two other items, that it presents financial opportunities possibly sooner. Pay-as-you-earn IBR lowers your debt-to-income ratio, increases your cash flow, and as a result, it presents other financial opportunities. Maybe you're able to purchase a practice sooner, resulting in a higher income, and you're able to manage your debt obligations a little bit better as a result of that. Something to consider. Another benefit is that there is loan forgiveness in IBR as well as pay-as-you-earn, so long as you meet the criteria. So with pay-as-you-earn, after 20 years of payment, you could be considered for loan forgiveness. Under IBR, any remaining principal balance could be forgiven, as well as unpaid interest can be forgiven after 25 years. So that's a significant benefit. I would imagine that some of you who have significant amounts of debt, in excess probably of $400,000, you may meet that criteria, 20 years under pay-as-you-earn, 25 years under IBR, that you have a significant amount of debt forgiven after that point. Some of the concerns with pay-as-you-earn as well as IBR: negative amortization. As I mentioned earlier, if your payments aren't sufficient to cover the interest due on the loan, that results in negative amortization. And I imagine for most of you who start off with pay-as-you-earn or IBR, that will be the case, is that your payments based on your income aren't sufficient to cover the interest due on a loan. Again, let's go back to a $500,000 student loan debt. On $500,000, if the interest rate on that loan is about 7%, you would expect the interest paid over the course of the year to be about $35,000. If you're making $100,000, if your AGI is $100,000, and you're paying under pay-as-you-earn, your annual payments would be approximately 9% of AGI, or about $9,000. So your negative amortization would be about $26,000 for that year. $35,000 in interest due, but you only made $9,000 of payments under pay-as-you-earn, resulting in $26,000 of negative amortization. That could be significant. Now, the capitalization rules. At what point does that negative amortization become a concern to you? And you need to be aware of this, particularly for IBR. It's mitigated under pay as you earn because the most interest that can be capitalized if you no longer qualify is no more than 10% of the original principal balance once you entered pay as you earn. So it's mitigated under pay as you earn. But with IBR, it could be that you're responsible for all the negative amortization being capitalized if you no longer qualify for IBR or if you forget to reapply for IBR, and that could be significant. So the negative amortization is capitalized in those two events, that you no longer qualify or you forget to reapply on an annual basis. The reason you wouldn't qualify for IBR is a result, or pay as you earn, is a result of your income being too high. With IBR, kind of the rule of thumb here is that your adjusted gross income should not exceed the level of your student loans once you entered IBR. So if you entered IBR at $500,000 of principal balance, then at no point during that 25-year repayment period should your AGI exceed $500,000. If it does exceed $500,000, then the negative amortization, the interest that you didn't pay at the point that you no longer qualify, gets added to the principal at that point, and that could be significant. So for IBR, kind of the general rule of thumb here is that you don't want your adjusted gross income to exceed your original principal balance once you entered repayment under IBR. With pay as you earn, it's a little bit more liberal. In pay as you earn, you don't want your AGI to exceed 150% of your original student loan balance once you entered pay as you earn. So if you have a $500,000 student loan balance once you entered repayment, then you do not want your adjusted gross income to exceed $750,000 in any 1 year during that 20-year repayment period. So again, pay as you earn is more beneficial in that respect. Third bullet item, even though you have loan forgiveness after a 20-year repayment period under pay and 25 years under IBR, that loan forgiveness is currently considered a taxable event, and this could be significant. So you want to be prepared for that, and you have to prepare for it right from the beginning. The fourth bullet item, you have to submit annually income verification, because pay as you earn as well as IBR are income driven repayment options. The student loan servicer has to verify your income on an annual basis to determine what your payments will be for that year under pay as you earn or IBR. So they ask that you submit your income, say your income tax, your personal income tax, your 1040s, on an annual basis to verify AGI, as well as to determine, or in order to determine your payments for that coming year. So if you're not familiar with your adjusted gross income, please look at the last line of the first page of the federal 1040 forms. That is your that will be your adjusted gross income. Again, the last line of the first page of the federal income tax return 1040 form. And this may be a little bit abstract. I would ask you to look at that site down there listed here to get a better understanding of the different repayment options. But again, as I was mentioning, this may be a little bit abstract. So let's get into some numbers. That way you can get a better sense of what I'm discussing. So let's take a look at first let's take a look at the standard 10-year repayment amount. So assuming that you have a loan amount of $500,000 and an interest rate of 7.5% over a repayment period of 120 payments, this would be your monthly payment, almost $6,000 per month. You have a starting balance of $500,000 with a monthly payment of about $6,000. Of that $6,000, you're looking at about $3,100 going towards interest, and then another $2,800 going to the principal balance. So you kind of get a sense of what's happening here. At the end of that first payment, your principal balance drops down to $497,000. But how many of you can afford a monthly payment of almost $6,000? I would imagine that most of you cannot. So you'll have to consider other options. One of the things to consider is, based on this 10-year repayment schedule, over the course of 10 years, how much will you have paid over the life of that loan? So total payments work out to about $712,000. So you've paid interest of about $212,000. So same concept with the 25-year repayment schedule. So $500,000 at 7.5%. Your monthly payments would be at about $3,700 per month. Still a significant amount of a monthly payment. So you probably may not be able to afford that. So something to consider would be to move to a different repayment option. And the most that you can extend your repayment period is up to 30 years. So here at 25 years, over the course of 25 years of repayment, your total payments would come out to $1.1 million. So you would have paid, about $600,000 in interest in addition to that original principal balance of $500,000. So obviously a significant investment. If you extend it to 30 years, your monthly payments drop not significantly over the 25-year repayment term, but it does drop about $125. But by adding an additional 5 years, you're looking at total payments of $1.258 million. You're adding another $150,000 in payments over the course of an additional 5 years as compared to the 25-year repayment period. So your total interest payments are about $758,000. So let me just change this real quick. Let's say you have $400,000 as opposed to $500,000. So your monthly payments would be about $4,750. So total paid would be about $570,000. So you would have paid a total of about $170,000 of interest over the course of 10 years. Over the course of 25 years, let's drop this down to $400,000. Your monthly payments drop to about $3,000 per month. So you see the total payments as well as the interest payments. 30 years, let's look at this. So you're looking at total payments of about $2,800 per month, or a little over $1 million total paid. But really what we want to focus in on is probably IBR as well as pay as you earn. And I'll do IBR first. I'm not going to go into too much detail here. I'll focus primarily on pay as you earn, but to give you a sense of what your payments would be under IBR, assuming a couple things. The assumptions that I make: there's only one in family, as well as that you're living in California. You're not living in Hawaii or the state of Alaska. So in this model, what they do is they do take in consideration family size as well as where you live in order to determine your discretionary income. So the assumptions that I've made here: there's only one in family, as well as the fact that you live in a state that's not Alaska or Hawaii. If your family size increases, and assuming your AGI stays the same, that means your payments will be lower as compared to one in family. But let's just go over some of this information. So I'm assuming an original principal balance of $500,000 with an interest rate of 7.5%. Under those terms, the standard default 10-year repayment amount would be about $5,900 per month. So the columns here are repayment year. So this will go through 1 through 25, and I'll scroll down. Adjusted gross income. Again, this is key here in this calculation. So you need to become familiar with adjusted gross income. It's a very specific tax term. So if you have questions, please feel free to call me to discuss your AGI. IBR, monthly payment based on AGI. Do you remain eligible for IBR based on your AGI? How much negative amortization? How much did you underpay in interest for that particular year? And this is a cumulative total. How much have you underpaid to the point, to your point of repayment? How much remains in the principal balance? And this is a total of the principal and unpaid interest, and these would be your annual IBR payments. So you kind of get a sense of what the payments would be. If you have an adjusted gross income of $80,000, your monthly payments would be about $800. Are you eligible? Yes, because your income isn't sufficiently high. As I mentioned before, with IBR, you would be concerned if your adjusted gross income exceeds your student loan balance once you entered IBR. So this would be an issue if your adjusted gross income exceeded $500,000. So you'll remain eligible unless you approach or exceed $500,000 AGI. So for this first year, you've underpaid the interest due by about $28,000. Not only have you not made sufficient payments to meet the interest payment, but you obviously haven't paid anything towards your principal. So after 1 year, you've underpaid the interest by $25,000. You haven't paid anything towards the principal, so the new outstanding balance potentially is $528,000. Over the course of the year, you made about $9,500 in payments based on this AGI of $80,000. And you can get a sense of what the monthly payments would be under IBR. So at about $197,000, you're looking at monthly payments of about $2,250 per month. At this point, that payment still is not sufficient to cover the interest due. And here, you've underpaid the interest by $10,000 for that particular year, at year 15 in this model. So at this point, after 15 years of IBR payments, you've underpaid the interest by $315,000. You haven't touched the principal, so potentially you have almost $816,000 of unpaid principal as well as underpaid interest. So for this year, you made a total student loan payments of about $27,000, and you can get a sense of what's happening here. So I'm just assuming income information. At year 19, you're at about $300,000 of adjusted gross income. At year 20, you have $350,000 of AGI, and as a result, your monthly payments under IBR are at about $4,200. You still remain eligible, and this indicates here that the payments are now sufficient to cover the interest due plus an additional $12,500. That additional $12,500 that is above the interest due then gets applied to the previous years of unpaid interest. So the unpaid interest amount goes down. So here it goes down from 321 to 309 because they're applying this additional payment towards that unpaid interest. So it doesn't get applied to the original principal. So at this point, potentially you have an outstanding balance of $809,000. So over the course of 25 years, assuming you plateau at 375, over the course of 25 years, you would have underpaid the interest by $232,000 and not have touched any of the principal balance of $500,000. So at the end of 25 years, potentially you have $732,000 that can be forgiven, based on the unpaid interest as well as the principal. So the course of 25 years, assuming these AGI amounts, you would have paid a total of $705,000 in IBR payments over the life of the loan. But the concern becomes this issue is this amount is forgiven, but it's considered taxable income to you. So at the after 25 years, let's assume that you start the repayment you start IBR in 2014. You make 25 years of qualifying payments. In 2039, you're done with IBR. In 2040, you're going to get, say, January 2040, you're going to get a 1099 cancellation of debt notice that indicates that you had, in this model, that you had $732,000 of loans forgiven. That will be considered taxable income to you. So you need to be prepared for that. And I'll get into that in just a second. What I go over under pay as you earn with respect to the amount forgiven can be applied to IBR in terms of the strategy. So let's go into pay as you earn. And again, this repayment method, if you qualify, is much more beneficial than IBR. So same information here. Your principal balance is $500,000. You have an interest rate of 7.5, resulting in the default standard 10-year repayment amount of $5,900, which I imagine for most practitioners, the first couple years, this amount is just too significant to make it manageable. So you go into pay as you earn if you qualify again. Same columns here. On $80,000 AGI, your monthly payment would be about $527 per month. The negative amortization, the interest that you didn't pay for that particular year, is $31,000. So obviously you haven't paid anything towards the principal. Your annual payments under pay as you earn would be about $6,300, again, based on $527 per month. So as you see your income rise here, the assumption I'm making for the first 5 years is that you're an associate. In year 6, you purchase your own practice. Your income may drop from your associate position because you have a lot of obligations with your practice, a practice loan. If you're buying an existing practice, you may lose some patients as a result of transitioning from the prior owner to you, but hopefully that income will increase, and will increase significantly over the course of your career. So you can kind of see the progression at year 20 or year 15, assuming an AGI of $197,000. Your monthly payments under pay as you earn would be about $1,500 per month. But still, you've underpaid the interest by about $19,000 for that particular year. Over the course of 15 years, assuming that those AGI amounts, you've underpaid the interest by almost $400,000. So that could be significant. And then let's assume over the course of 20 years, at year 20, you have an adjusted gross income of $350,000. Your monthly payments under pay as you earn or about $2,800. Still at $2,800 per month, it's not sufficient to cover the interest due on the loan. For this particular year, under these assumptions, you would have underpaid the interest by about $4,000. So the course of 20 years, you would have underpaid the interest by $454,000, and you wouldn't have touched the principal of $500,000. So you would have, you potentially would have will have about $500 or $954,000 forgiven, and that could be significant. But assuming these income amounts, your total payments under pay as you earn only amount to about $296,000. So at this point, if you only took into consideration your annual payments and assuming these AGI amounts, you borrowed $500,000, you've only made total payments of $296,000. So obviously this is a very attractive repayment option. The concern becomes this amount forgiven. The amount forgiven in this situation is estimated to be about $954,000. And you have to take into consideration what the tax liability will be 20 years into the future for that amount forgiven. So let's assume again that you start the repayment option, pay as you earn, that you qualify. You start the repayment option in 2014. After 20 years, this model is accurate. You have $954,000 forgiven. You're going to get a 1099, say in January of 2015, reporting that you had $954,000 forgiven. You're going to include that in your AGI, and assuming that you live in California, I would suggest to students, and the concern here is predicting what tax rates will be 20 years into the future, and it's impossible to do, but just for discussion purposes, let's assume that the effective tax rate at that point is a total of 50%. I'll attribute 40% of that to the federal income tax rates and 10% for the state of California, resulting in 50%. And as a result, then let's assume total tax liability equal to, let's say, 50% of this amount. So that's what you would have to be prepared to pay once you have that amount forgiven. So this is a significant tax liability, and it would be a lump sum payment that you would have to make, assuming that everything's accurate. So let's say come April 15th, 2035, in addition to whatever you paid up to that point, because of the loan forgiveness, you would have an additional tax liability of almost $477,000 due. Obviously, a significant payment. So you have to plan for this event. I would suggest as soon as you enter either IBR or pay as you earn. The IBR tax liability is going to be different. And if you have questions, if you are in IBR, you can't migrate to pay as you earn, and you want to get a sense of what your tax liability will be, give me a call and we can discuss your specific situation. But in either case, whether you're in IBR or pay as you earn, you need to plan for this event as soon as you enter either of those repayment options. And what I would suggest that you do is that once you enter IBR or pay as you earn, because you're lowering your monthly payments as compared to the 10, 25, or 30-year traditional repayment options, I would suggest that you begin investing some of those savings into investment programs. I'm not going to suggest anything now, but that's something that you would want to consider. So let's try to calculate what you would need to have in order to invest on a monthly basis in order to be prepared for this tax liability. So let me do a future value calculation. So let's take a look at some options. So I'm going to assume an annual rate of return of 7%. And the reason I'm choosing 7%, it's kind of a historical amount for the S&P 500. The S&P 500 tracks the 500 largest capitalized public companies, and historically that return is at around between 7 and 8%. So I'll assume a 7% annual rate of return, but we're going to invest on a monthly basis. So I'll divide that by 12 to get a monthly return, and we're going to be doing this over the course of 20 years on a monthly basis. So I'll multiply 20 times 12 to get 120 investment periods, or excuse me, 240 investment periods. And let's assume that I'm going to invest, say, $1,000 per month. So over the course of those 20 years, and $1,000 per month, my total investment return would be about $520,000, $521,000. So that's sufficient to cover this total tax liability. So in this, if you plan properly, you can do this. You can have funds available to meet this tax liability as a result of this amount forgiven. So let's change a couple variables. Let's say that you want to do, say, instead of $1,000 per month, you want to do $800 per month. And as a result, your investment return over the course of 20 years, assuming a 7% return, comes out to about $416,000. So you're about $60,000 short of this tax liability, but still you're in a position to afford it than you otherwise would. Let's change this return rate. So let's say over the course of 20 years, instead of a 7% annual return, you get a 9% annual return. So here, as a result of a 9% as opposed to a 7% return, you're looking at an investment value of about $534. Let's look at the reverse. Instead of saying a 9%, you get a 5%, which is below the historic average for the S&P 500. So in this case, you have an investment return of about $329,000. Just to give you a sense of what the values would be, assuming different rates of return. But let me go back to the original assumption. Let me go back to 7% annual return with a $1,000 per month investment. So given that, you're looking at a total investment value of $520,000. So what I want to do is show you what the true cost of the loan is then over the course of this repayment option. What I want to do is calculate how much I made in total payments here, as well as how much I invested over the course of 20 years in order to be in a position to pay this tax liability. So what I need to do is say my annual investments were $1,000 per month over the course of 240 or 20 years. So that's my investment value, or excuse me, my actual principal I invested, plus what my payments were over the course of pay as you earn. So I add these two together, and as a result, my total payments come out to $536,000. Again, over the course of 20 years, assuming these income amounts, these adjusted gross income amounts, my total payments under pay as you earn would be about $296,000. I add that amount to what I invested on an annual or on a monthly basis over the course of 20 years. So I'm assuming here that I'm investing $1,000 per month over the course of 20 years, or 240 months. So that's $240,000 plus $296, and as a result, my total payments come out to $536,000. So from a dollar perspective, my interest payments are really $36,000. So I borrowed $500,000. I paid over the life of that loan really $536,000. So about $36,000 in interest, which is obviously a very good interest rate over the life of the loan. So even though this loan has a stated rate of 7.5%, because IBR, excuse me, pay as you earn, is a payment based on income, the actual interest rate may be significantly less. And the interest rate on this loan, let me just make sure this is correct. So I'm making $1,000 per month in investments over the course of 20 years. So my actual interest rate on this loan is about 0.7 of a point. So this will probably be the cheapest loan that you ever have. So if you take advantage of pay as you earn as well as IBR, this could be a significant savings as opposed to other repayment models. It's just a matter of managing this process very closely and very well. Let's assume something else. Let me assume that something changes in this model that causes your total interest to go up. Say at this point you stay at $256,000 on an annual basis, just for kind of discussion purposes. And as a result, what's going to happen is that you will have underpaid the interest by a little bit more, and as a result, you would have had this amount forgiven. But it does result, because your AGI is lower, it does result in a lower pay-as-you-earn payment. So here it drops to $281 as opposed to, I believe it was $296. The total amount forgiven comes out to about $484. Excuse me, the total amount forgiven comes out to about $968, which is higher than the previous model. And as a result, your tax liability goes up to about $484. Your investment stays the same because we're not changing anything here. So you should have sufficient money to pay this tax liability, assuming again a 7% annual return for 20 years on a monthly investment of $1,000. Your total cost of the loan actually drops. So in this case, you pay back a total of $521,000, and your interest rate on this loan drops down to 0.4 of a point. So you need to prepare yourself well if you're in pay as you earn or IBR, and manage this process properly. the keys to this process is knowing what your adjusted gross income is, and planning for that from a tax perspective, as well as making certain that you remain eligible for pay-as-you-earn as well as IBR, and that you're submitting the appropriate documentation on an annual basis. Your loan servicer will contact you probably 2 months in advance of when you need to submit your annual documentation, so you'll have sufficient time, but you have to do this on an annual basis for the 20-year repayment period under pay-as-you-earn or 25-year repayment period under IBR. So that's one of the concerns, making certain that you reapply to make certain that you continue to be in these programs. So there's just significant benefits here, particularly with pay-as-you-earn, but you need to be aware of them and you need to plan properly. I'm more than happy to provide my services to assist you in either pay-as-you-earn as well as IBR. I am an enrolled agent, which is a license issued by the Department of the Treasury to prepare taxes, tax advisement, things of that nature. So I'm in a unique position to assist you. I do have extensive knowledge in student loans. I'm familiar with pay-as-you-earn as well as IBR. As an enrolled agent, I can help you from a tax perspective, particularly looking at your adjusted gross income, what factors go into AGI. My wife is a dentist. She owns her own practice. She has it set up as an S corporation, so I'm familiar with that aspect as well. Completing corporate tax returns, things of that nature. So I'm available either by phone or by email. So don't hesitate to contact me to discuss IBR, pay-as-you-earn, and tax concerns that you might have. Thanks for taking the time. I appreciate it. I wish you guys the best of luck.